All right, well, we may still have some people trickling in, but we can go ahead and get started. Good afternoon, everybody. Thank you so much for joining us. Welcome to what we hope to turn into a quarterly webinar series. We're calling it our educational webinar series presented by Altus Receivables Management. As a lot of you may already know, Altus is a longstanding member of the accounts receivable management industry. So really, we just work to provide our clients with as many resources as we can and best practices to help everybody keep a firm grip on their business-to-business recovery processes. So my name is Leah Skye.
And I'm Dan Grenemeyer.
My partner in crime. And we've been working as AR specialists, assisting companies with credit and collection issues, ranging from tiny mom and pop businesses all the way up to Fortune 100 powerhouses. What we found is that regardless of a company's size, there's always going to be room for improvement when it comes to how they collect their cash. So we just wanted to share some insight on that. But especially given how unique this year has been and how difficult the last 19 or so months have been with regard to the financial climate, we thought it would be appropriate to just have a discussion, kind of a peer-to-peer discussion regarding some of the changes and the challenges mostly that we've seen as it relates to credit and collection efforts. So as you know, today's webinar is titled COVID's Impact on Accounts Receivable and Economic Trends to Watch. So we really want to make this session as collaborative as possible. So as Dan mentioned earlier, feel free to jump into the Q&A portion, answer the polls that we threw out there. We really just want you guys to have a voice in this, and we're interested in hearing what your experience has been as well. And we will address the poll results and do some Q&A at the end of the session as time allows. So without any further delay, let's go ahead and get started.
Thank you, Leah, for that great introduction. So I guess to rewind a little bit, back when lockdowns were initially put in place back in March of 2020, we had a lot of clients coming to us for answers, advice, suggestions, predictions. We started pretty closely monitoring bankruptcy trends at that point. Just kind of as an anecdotal thing, we had a lot of debtors telling us that they couldn't pay because their business had been impacted by COVID or they needed extended payment plans. We knew that the lockdowns really affected some industries deeply, but pretty much affected everybody in some way. So personally, I expected 2020 to be the highest year in U.S. history for bankruptcies. The data that we actually found was quite the opposite. I was astonished to review this study by the American Bankruptcy Institute and see that in 2020, bankruptcies were actually at a 20-year low. Around that time, Lee and I were starting to be asked by some trade associations to make presentations similar to the one that we're doing today. It was a challenge because a viral pandemic was completely uncharted water. The most recent recession that we had was 2008. So that was the most relevant data that we had to compare to. What we started to see was pretty interesting. So if you look at the far right, the large spike, that's 2020. That's the height of the lockdowns. So unemployment claims absolutely spiked during that time. If you compare that to 2008, it was about 4 times the amount of unemployment claims filed. And this chart goes all the way back to 1967. So you can see that we saw a record number of unemployment claims filed in 2020. The next data set that we evaluated was mortgage delinquencies and foreclosures. I had expected that if we saw a 4 times spike in the people filing for unemployment, that a spike in mortgage delinquencies would follow. What the data actually showed was even the initial spike while the country was under lockdown was significantly less than 2008. So while we had 4 times as many people filing unemployment claims as the previous slide showed, we saw very few mortgage delinquencies by comparison. If you look closely at the chart, the red tips signify actual foreclosures, so the most severe form of delinquencies. The blue is 30 to 60 day, the yellow is 90-day delinquency. But even with everything that was going on in 2020, the most severe form of delinquency or foreclosures, those red tips, are significantly less than we saw during the 2008 recession and then following that. Another unique trend that followed the pandemic was more Americans have quit their jobs than any time in history, contributing to also a huge spike in job openings. So employees are leaving their jobs. Not all of the workforce has returned after after the initial spike in unemployment. However, to puzzle us more, US home ownership rates spiked. So even after we saw as many people quit their jobs voluntarily, the high rates of unemployment, US ownership was at the highest rate since 2008. So when you look at the last 4 years, so this compares essentially the 2 years before the pandemic to 2020, when at the onset of the pandemic, and then also 2021. Graph A is interesting because it shows the number of new business applications, and it shows that more new businesses have opened up since the pandemic than the 2 years leading up to it. Graph B, the graph on the right, shows that bankruptcies were even lower than 2020 so far in 2021. So in 2020, if you remember the first slide that we went over, it was a 20-year high in bankruptcies. We're seeing, excuse me, I apologize, a 20-year low in bankruptcies. We're seeing even less bankruptcies in 2020. And this is even after the freezes in Texas, the wildfires in California, supply chain issues, and disruption and upheaval at so many levels. So at this point, I'd like to ask for some audience feedback. If you can, find the chat feature. It should be the fourth button over on the bottom of your screen. And if you don't mind, just put out there what you think may be the cause for this and why it's so different. The results of the 2020 viral pandemic versus 2008, and why the numbers are so different. So I'll give just a few seconds, let a few people respond. One answer was consumer spending. I think that's definitely a factor. Customers became cautious with spending. I think that's also a good answer. Supply chain demand, absolutely. All right, well, keep chatting. I'd love to hear what everybody thinks. I'm going to jump into the next slide. We believe the biggest difference was the influx of money into the economy from our government. We saw stimulus from loans, grants, tax deferrals, subsidies, and other programs, both at the business level and at the individual consumer level. There was an economic bailout in 2008, but it wasn't near the magnitude of this. This graphic illustrates a few of the programs that the government put into place immediately following the onset of the pandemic. The Committee for Responsible Federal Budget estimates that in total, 8.7 trillion has been dispersed and a total of 13.3 trillion has been allocated. So to put that in perspective, that's about the 8.7 trillion that's been dispersed so far is around 40%, by comparison, 41% of the US GDP. That's money that's been pumped into the economy, and we believe that it's upheld businesses and artificially reduced the number of bankruptcies, mortgage foreclosures, and other delinquencies that we would have otherwise seen. Anytime that we see an influx of money like this, inflation should be monitored very closely. If you looked at housing prices lately or bought groceries, you probably have your own anecdotal experience and evidence of inflation. But the US Bureau of Statistics is reporting the highest level of the Consumer Price Index since 2008. Here are a few other things to consider. These topics could probably each be a webinar in their own, but I wanted to mention a few. The first is we don't know how long the government funding will last. Personally, I think it's probably unsustainable at its current levels. There are continued initiatives like Build America Back Better and framework being introduced for economic and environmental and social bill spending. We're facing issues right now with fraud. Crooks and fraudsters saw money flowing into businesses and put their hands out. So it's just kind of a fair warning. Do your due diligence with new customers. We've had a few clients come to us already with companies that were placing orders and trying to look legitimate and appear operational before a government review to look at the money that they'd taken. There was also some significant changes in the bankruptcy laws. So we saw nearly a threefold increase in the limit for Chapter 11 reorganization. So what that means is a company that has assets who wants to reorganize instead of liquidate can now file Chapter 11 bankruptcy with up to 7.5 million in debt. That's an increase from 2.7 million. There's concern that we're going to see a spike in bankruptcies in the first quarter of 2022 because this increase is only temporary and it ends on March 27th, 2022. So what that means for you is that there can be a preferential payment window, meaning any payments made 90 days before bankruptcy filing date can be pulled back or clawed back from the bankruptcy court. So we're encouraging our clients to make an effort now to collect so that any payment you receive is outside that preferential payment. The takeaway is that COVID-19 changed our world, it changed our economies, it changed the way we live, the way we work, and the way we connect. And I'm encouraging my clients to proceed into 2022 with an abundance of caution. To make this even more relevant to our audience of financial professionals and business owners, with all the changes we've seen, the one thing we believe won't change is that the age of a receivable remains the largest determining factor of collectability, and the likelihood of collecting an aged account decreases incrementally over time. So if you have companies that owe you now is the time to collect. When you know they have government stimulus that's been financing their company. Here are a few things I hope you take away from this, and that you may want to ask yourself and talk about internally. What's your strategy to manage accounts receivable? Has it changed? Should it change? Should you change your policy on extending credit, adjust existing credit limits, or your risk tolerance for new customers? What information are you basing your decisions on? And are you having discussions internally within your company to strategize and plan? And with that, I'll turn it over to my co-host, Leah Skye, for some additional suggestions to make the best use of your internal resources and tools you can use to evaluate and mitigate your risk. Leah?
Those are some great points, Dan. Yeah, so kind of picking up where Dan left off, one of the best pieces of advice that I can share with any of my clients is that time is money, right? The age-old adage. And your AR team is only capable of doing so much in an 8 or so hour workday. So I completely understand that when you're staring down at a list of hundreds of past due accounts that all need to be called, it can be extremely overwhelming. But if you break it into priority groups, you can kind of ensure that your team is being as efficient as possible with the time that they do have in their day. So one of the easy acronyms that we use, the ABC method, easy to remember, right? Which can help you determine really who is your biggest priority or who should be your biggest priority, and who should be the major focus in how they're spending their energy. So the A in ABC is, of course, age. We all know that how far an aged receivable is from the invoice origination date is very important. And it's all relative, because if it's just 1 day past due, it might not be a major cause for concern. Maybe someone missed the bill, was out on vacation, things happen, we get it. But if you're looking at something that's 90, 120 days plus, now you obviously know that you've got a more serious concern on your hands, and that account requires some more attention. The B is for balance, of course. How much do they owe? Obviously, a $100 receivable versus a $100,000 receivable require different amounts of attention. So self-explanatory, the larger balances, of course, should take priority. And then the C is for credit risk. So what does their credit score indicate? Are they at risk of bankruptcy because they've got piles of tax liens and judgments against them? And if so, obviously those accounts require immediate action, because they might not be around that much longer for you to have the ability to collect. But the benefits of staying on top of these higher priority issues obviously means you're going to be made aware of problems before it's too late to take action, before you get that dreaded bankruptcy notice in the mail. Just making sure that you're focusing on the largest, the oldest, and the highest risk balances is going to be of paramount importance, because you just do not want to be the last one to catch an issue, because if every other creditor has taken action, you're going to be much less likely to get paid, unfortunately. So one of the ways I love to do this with my clients and help keep tabs of the overall health of their AR is to run what I call a big picture aging review. So this is just an example of a free aging report that we do for our clients. I know a lot of people on this call have actually done these with Dan and I before. It's a really helpful tool. Basically, our clients will ask us to import the credit score of their entire aging. And this allows them to sort by the ABC categories. So you can actually go in and you can sort by who has the most tax liens, for example, or who has the highest concentration of collection issues. And then you can work with your team and you can create a call list based on the level of risk of each particular customer. And you can also, of course, sort by the age and the balance bucket. So like I said, you're hitting the most important accounts, the highest amounts, the oldest amounts first, so that you can make those the highest priority and hopefully get those paid as quickly as possible. So if by doing this, you identify some problem accounts, which I can pretty much guarantee you will, we've put together just a couple of measures that you can take to determine your next step. So on a more singular basis, you can pull just a single detailed credit report and you could do a deep dive on that particular customer. You can look at their payment trends, of course, on that credit report. I know that a lot of customers are blaming COVID, unfortunately, for their inaction on getting bills paid. So what you can do is you can look at that credit report and drill down their monthly trends. And you can see, has this always been a slow payer according to their other creditors, or was there a significant dip post March 2020? And that'll give you an indication of whether you're getting the real story. But you can also speak to vendors. Having relationships, I think, with your competitors is extremely important because they're going to be a wealth of information. And you can find out if they're sharing the same experience as you, if they're, constantly having to ride that customer for payment, or if maybe they pay your competitors on time and they've only chosen not to pay you. That's pretty concerning as well. And then you can look at your own payment history, of course, just diving back into the records of, have they always paid you slow, or is this brand new? Promissory notes, I love. If you've got a customer that's, for example, on a payment plan, we all know those, and you're worried that, perhaps they're going to default on that payment plan and then leave you with a large outstanding balance, you could always have them sign off on a promissory note with a personal guarantee included. And what that is a legal document that allows you additional recourse on an individual in the scenario where they did default, and, worst case scenario, if they had gone out of business, you still have the ability to try and collect from them as an individual. And then lastly, I always recommend just revisiting your own credit application or contract language. You'd be surprised at how many of my clients haven't done that in 10 or so years. And the world has changed since then. So you want to just make sure that you have protected language in there in the event of a default. So for example, do you have a stipulation in there that allows for you to add collection fees or legal fees if you have to take further action to get yourself paid? So that's always worth looking into as well. So another thing that I like to always do on these educational calls is just go through exactly what a credit report looks like. So it might be super familiar to some of you, and to others, this might be brand new information. But basically, I want you to see what you should be looking for when you're researching either a current customer or maybe a potential customer that you're looking to determine a credit limit for. In my experience, the most reliable resources are Dun & Bradstreet and Experian, strictly because they have the highest number of data contributors. They have the most vast resources. And really what that means is that's the number of creditors who are reporting their data to the credit bureaus. Most report to D&B or Experian, many report to both. But that, the higher the data contributors, the more accurate the depiction is going to be of that company's current financial health. So typically what you'll see here, this is the top of the credit report that we sell. We do a blended of D&B and Experian, but basically what it is a big picture look at the top. And as you get further down, it drills into more specific details about their payment trends. So this, this particular one is on REI, who we all know is a recognizable player in the outdoor sports retail industry. And thankfully for them, they were thriving through COVID because people were home and had a lot more time on their hands and wanted to get out and learn to paddleboard and do all the fun things they never had the time to do before. So overall, this company is pretty low risk, as can be expected, but I'll show you the reports here on this slide just to get into the detail of how that determination was made. So you've got your monthly payment trends, which are really important to look at, as I mentioned. Monthly is going to give you a current idea of what's going on, because a business that paid you on time when you worked with them, say 2 or 3 years ago, it's very possible that they're in a completely different situation now. So you want to make sure you're checking their credit score and getting up-to-date information. Just given how volatile the financial climate's been over the last 19 months or so, I think it really, I can't emphasize enough how important it is to look at payments on a monthly level so that you're getting recent information on how they've been behaving over the last few months and seeing how COVID has affected them. But As you can see from this report, obviously, REI pays the majority of their bills on time, or at least within 30 days, which makes them a pretty decent credit risk. But a lot of companies that you look at the credit report for are going to show much higher levels of delinquency. So if you look in that 61 to 90 or the 90 plus category, if you're seeing 60, 70, 80% of creditors are reporting them in those age buckets, that is not a good sign. And then lastly, here on the right, arguably the most important piece of any credit report is going to be the derogatory remarks, because this is, I like to call it the skeletons in their closet. It's basically the information about a company that your customer would probably never share with you voluntarily because it doesn't cast them in a good light. Any judgments that were placed against them by another creditor because they weren't getting paid, any tax liens that the IRS had to file against them because they were late or didn't pay on their taxes. Obviously, collection placement. So any company like Altus that has a case against them is going to report that information. And I just think it's really important for a creditor to have that available to them in order to make an educated decision on how you're going to handle a non-paying customer. But then also really importantly, when you're determining a new credit limit for a company you've never sold to before, because you don't want to just take their word for it that they're going to pay. You want it to be backed up by data, and they need to be able to show that they've got a good history of paying their creditors. So I know Dan touched on this earlier. Obviously, we all know there's been numerous government assistance programs offered to businesses. So if you are having an issue with a customer that's citing COVID cash flow issues as the only reason that they can't pay, you do have the ability to check and see if they took advantage of a PPP loan. So the link up here at the top, we'll send out this presentation. You guys can feel free to copy that down. Because we've seen a ton of debtors placed in our system by clients who were just straight up being lied to. They were being told that the company was completely void of cash, but then when it was placed with us for collections, our collectors start doing research and they realized that this company was injected with a multi-million-dollar PPP loan, which sort of provided them some relief. So I think just knowing this as a creditor can help you determine the best next course of action. And you can also just gauge intent, because if you're being lied to, obviously, this is not an honest customer that you want to give a break to. You want to just move on and protect your interests. So this is another thing Dan mentioned with the huge unemployment numbers. A problem that so many businesses are facing recently that a lot of people don't really want to talk about is the just total lack of staffing. So if you find that your team just doesn't have the capacity to follow up on things like, for example, researching whether a customer's gotten a PPP loan disbursement or pulling a credit report, that may be an indicator that you're just understaffed. I know firsthand from my discussions with clients that a lot of companies cut their collection staff dramatically during the pandemic, but now that sales have in a lot of industries resumed normal figures, they're left with a high volume of accounts that need to be followed up on, and they can't properly service them. So just kind of a rule of thumb that we work off of, typically one AR rep should only be handling maybe 200 to 250 open accounts. And if you have a portfolio of, say, 1,000 open accounts, you should have at least 4 or 5 employees that are handling the collections to ensure proper coverage. I think the days of strapping down one AR rep with 2,000 accounts to call in a day are behind us. With the Great Resignation, people want to make sure that they have a reasonable workload during the day. So rather than, possibly ostracizing your employees, you should consider looking elsewhere and getting some maybe temporary staffing solutions. Because that can give you the coverage you need without actually having to hire externally, pay for benefits, train them, et cetera. So Altus has a program like this. Other companies do as well, where basically you are provided a trained AR professional that can act as an extension of your collection team. And like I said, it can be temporary. It can be for a couple months or years at a time, whatever works for you. But basically, it just helps ensure that you don't end up in a hole of debt without the manpower to cover it. You can pay for a full-time employee, like I said, on a monthly basis. You can just bring them on to help with maybe an acquisition that you went through that had a huge influx of new accounts. You can outsource just a portion of your portfolio in order to free up your team's time during a particular busy season, or maybe just have them, focus on their top tier clients and have someone outsourced to work your bottom, maybe 80% or something like that. There's a lot of ways you can swing it, but it's an option out there, and I think that people should explore it if they are running into some of those difficulties. in summary here, we get it. We understand that there really is a very human element to collecting, and I don't think that that should ever be overlooked. The last year and a half really has presented so many challenges for people on both a professional and a personal level. So I think just trying to exercise a strategy that takes that into account is going to bode well for anybody looking to connect with their customers and find some success in getting them to pay. But with that said, you can't be a doormat. Because, I think if you use the tactics that we've gone over, it'll allow you to ensure that you really have tried everything possible on your end to give your customers the benefit of the doubt and an opportunity to pay. But if they refuse, you've done everything that you can, and you can really rest assured that nothing was left on the table. Because I think it's important to remember that the onus at the end of the day is on your customer, and they have a responsibility to pay within the terms that were set forth in the beginning of the relationship, and they have a responsibility to communicate with you regularly if they're going to miss that deadline. And if they fail to do this, and you have done everything possible on your end to proactively work with them and give them an opportunity, then there really shouldn't be any hesitation on taking further action, whether it be placing it for collections or litigating against them, whatever you need to do to recover the debt. So just a quick little summary about who we are. I know a lot of people on this call already work with Altus, and if you do, thank you very much for your business. We value your relationship, and anyone who's not super familiar with us, we are the largest B2B receivables management firm in North America. And we've had a bird's eye view on just the severe impact, unfortunately, that COVID-19 has wreaked on the country and, anyone selling really on a B2B basis on credit terms. So we've had an opportunity to get some really interesting perspective on the situation. So our main goal of this webinar was we wanted to just share some helpful tips with our community, and we want to allow your team to do everything they can to reduce DSO, keep your business healthy, and just help your business and your customer relationships thrive in the process. But our intention of this discussion isn't to sell you here on Altus services, but rather just kind of give you some tools, suggestions, helpful tips, best practices to get as much money put back into your business as possible. Because obviously none of us could have predicted this pandemic, but hopefully some of this information can at least help you find yourself better prepared for crises in general going forward. Knock on wood that they are minimal or non-existent. But Dan and I are, of course, always here on a free consultative basis just to help your AR team steer you in the right direction if you do have questions. And we'll provide our contact information in this presentation to all of the attendees as well. So please don't hesitate to reach out if there's anything we can do for you.
So now my favorite part, little Q&A. So I was kind of reading through some of the questions, and I'll take the first one and give Leah a chance to take a breath. But this was a really good one. Our end customers are primarily local governments. What impact do you see on the funding for these entities? Will their tax revenues fall or collapse in the near future, or maintain historic levels? I think that's a really tough question to answer. I think it's a great question. I think that collecting from the government could probably be its own hour-long webinar and still not cover everything. What I can tell you is from having been in this industry in 2007 and 2008, during the last pandemic, we saw more, and this is just anecdotal, but we did see more government entities, sheriff's departments, Department of Defense, the Army. West Point was even placed for collection at one point by one of my clients. So we saw an increase. And I think really looking behind that, I think that they are affected by this. If you think about government entities, they can only pay what's been allocated to them. So if that's been reduced because that funding's gone somewhere else, I do think things will slow. So I realize that they do have to be treated a little bit differently. But if you get to a point where you feel like they're not going to come through, we're always happy to help with government entities. They have forfeiture accounts and special ways that they can pay if enough pressure is applied to them. So I hope that answers your question. Definitely reach out to me offline if you want to talk about that more. The next question, I'll kick over to you, Leah. It says, at what point in time should I be concerned about a customer that is citing COVID cash flow restrictions as the main reason for non-payment?
Well, I would say the simple answer is immediately. And The reason for that is because any reputable company should have at least some cash reserves that are going to help get them through this time. And they should have ideally been planning for a rainy day all along to protect the business, right? Like, obviously, this pandemic could not have been predicted by anyone at all, but there's always a chance that something horrible is going to happen, whether it be a natural disaster or a global pandemic. And just like any individual that should be budgeting for how to take care of their family in light of an emergency or something like that, I don't think any company has a right to be riding a line so thin that they have absolutely nothing that they can fall back on when something like this happens and things get tight. I think that when companies are saying that the 100% reason that they can't pay is because of COVID, I think what they're really saying is that they've been fiscally irresponsible up to this point, and COVID was kind of the straw that broke the camel's back, so to speak. Because if they're that weak, I would venture to say that they've had liabilities probably building up and being put on the back burner for years. And just the added stress of this pandemic is just what brought it to light. But it can't be 100% the source of their inability to pay, especially with all of the assistance programs that were out there for them to take advantage of. Are there exceptions to that? Of course. But I would say, generally speaking, most companies really shouldn't be using that as the only reason that they're not paying. And I really think, if you guys as a creditor have an outstanding balance due from a company that is telling you that they're that weak and that unprepared, you really should consider taking action before they go out of business entirely, because that sounds like a company that's ripe for insolvency and bankruptcy. And that's the last thing that you want as a creditor to be in the position of if you have an outstanding balance.
It's a great answer, Leah. We had another really good question come in. Does a personal guarantee work? The banks and other institutions seem to be first in line to recoup. Would a letter of credit be a better option? So I'll take that, Leah, unless you have a burning desire to. But I think that personal guarantees, they do work. I think that if we think about the enforcement of a personal guarantee, that usually has to be a legal action, meaning that you would sue them and then you try to obtain a judgment lien, garnish a bank account, try to maybe seize some real property or assets that they have. So just having the personal guarantee, having it signed is good leverage, letting them know their personal assets are at risk. Now they can also bankrupt personally to get out of that. The letter of credit can be good. There's usually a cost to it. We don't offer letters of credit. It's not a service that we offer. So what I know of it, I've seen clients that had letters of credit, and like any good insurance policy, there's a way to wiggle out of it. And we've seen banks deny those. So I think that they both have their own advantages if they're used properly. Leah, would you add anything to that?
Yeah, I mean, I think a personal guarantee is only as good as the person who signs it, right? So if you've got somebody who has absolutely nothing and they sign a PG and the company goes out of business, you're still not going to be in a better position. But as Dan mentioned,
Leah, I think you might have muted. I can't hear you. Sorry about that. I'll answer a few more questions. Leah, hop in if you're able to speak again. I couldn't hear you, so I'll answer another couple questions here. This one says, what is your prediction on how long it will take to recover from the last year and a half? I think the challenging part of this is any analyzing or planning that we try to do. Like I mentioned before, this is something we've never seen before. We've seen other financial crises, but they've never been a viral pandemic. So much of what happens going forward depends on continued infection rates, government responses to them. There's no easy solution. I think one of the biggest challenges that we face right now is getting people back to work. I think the government has some tough decisions on when they're going to taper some of the stimulus, some of the extra unemployment benefits that were being paid. So to be honest, we don't know. A lot of it is stuff that we'll wait and see, how it plays out and how the the government is able to kind of tailor this and work away from upholding the economy with future stimulus. All right. I got one more here. What is the single biggest thing I can do to protect my business? So I remember Leah actually saying in a prior webinar, and she used to make everybody repeat after her when it was live, that not everybody deserves credit, and I think that's so true. So my advice, I think the biggest way you can protect your business is to check companies out before you do business with them. We've seen six-figure accounts come over to our agency where a client gave credit to somebody without even checking their credit. So carefully review who you're doing business with, do your due diligence, whether it's through a batch format like Leah showed, or whether you're evaluating new customers one-on-one. So just keep in mind, if I walk into a Ferrari dealership and they run my credit, they're not going to sell me a Ferrari because I don't deserve one. And not everybody who comes to your door or emails one of your salesmen deserves credit as well. So that was a really good question. Leah, I think Leah is still having some technical difficulties. So there's a question here that I thought was pretty good about, it says, where are goods being held in the ports? And essentially the question is, what happens if my customer didn't receive the goods? So that is something that's real, something that's been a challenge. We represent a lot of companies that are in freight. And at the end of the day, I think you need to work with that customer. You need to find out if there's a way to resolve that amicably, because we know that there are truly some freight delays and we know that those are causing problems. But at the end of the day, that customer needs to communicate with you. They need to be in conversation with you. They need to be letting you know what the issues are. And you can work through it together. At the end of the day, they're responsible for payment for the goods that they receive. And they need to understand that a lot of these freight delays are outside of your control. So I'm going to look through here. What I'll do next, I think I'm going to share the results of the poll. If you haven't had a chance to complete the poll, please do it quickly, and I'll kind of share where things are at. So the first question that we asked was, what is your economic prediction for 2022? 27% of the people that responded said that they believe the economy would strengthen in 2022. 32% said it would be flat, and 41% said it would weaken. When we asked, what are you most concerned about in 2022? 45% said the financial solvency of my existing customers. 27% said being able to properly staff my company and or fill job vacancies. And 32% said evaluating credit risk of new customers. So we really appreciate you answering those questions. I'll put Leah and I's contact information up. If you have any questions, if you need anything at all, please reach out to us. You will get a follow-up email from Zoom with kind of a survey that'll put out some potential areas that you might want to see us focus on for the future webinar. It should have our contact information as well. So we hope this got some people to think about some things. Maybe you learned a few things you didn't know about some of the economic trends, but thank you so much for joining us today and being part of this webinar. I'll apologize for Leah about the audio issues. I know she would like to really answer some of those questions as well, but feel free to reach out to her or I directly. And thank you again for joining us. Have a great day.
Thanks so much.